Welcome back to the deep dive. We're here to unpack some really fascinating sources, pull out those insights you might miss. And today it's pretty special. We're basically stepping into a financial time capsule. We've got a letter from 1958 written by a young Warren Buffett to his partners. Now, our mission isn't just, a history lesson. We want to pull out the timeless stuff, the investment principles, market psychology, how value gets created, all from this snapshot over 60 years ago. It's a pretty unique window, right, into the strategies that built this, well, financial empire.
Exactly. And it's more than just an old document. It really is a blueprint. We're going to see how Buffett, way before everyone knew his name, how he thought about the market's mood, how he handled expectations with those early investors, and maybe the best part, we'll dig into a specific investment he made. Super detailed. It really shows his whole approach in action.
Okay, let's do it. Let's unpack this. Where should we start? Maybe the general market mood back then, 1958. Buffett actually quotes a friend, someone running an investment trust, described the market as having a, quote, mercurial temperament, said it was exuberant.
Oh.
He mentions that almost any reason has been seized upon to justify investing in the market. It sounds kind of familiar, actually. He even points out there are undoubtedly more mercurially tempered people in the stock market now than for a good many years. So picture that. Everyone's jumping in.
Yeah, it's a classic setup, isn't it, that kind of mood? And Buffett, he doesn't just see the exuberance. He thinks about what it means. He says, basically, these folks chasing quick profits. Their stay depends on how long they think the easy money will last. And here's the really sharp insight, I think. The longer their visit, he writes, the greater the reaction from it. So what does that tell you? When everyone believes profits are inevitable, it sets the stage for trouble down the line. He saw that cycle clearly, even back then.
And what's really crucial here, amidst all that frenzy, is Buffett's own stance. He says, point blank, he doesn't try to forecast the general market. Nope. All his effort goes into finding undervalued securities. That's a huge distinction, right, from how so many people operate.
Absolutely. But, you have to wonder, in a market that's just going straight up, wasn't it tempting? Tempting to just, ride the wave a bit. He actually tackles that. He admits that if this belief in easy profits does eventually cause problems, then prices, but not intrinsic values, in my opinion, of even undervalued securities can be expected to be substantially affected. So even if you find a bargain, its price can still get hammered in a sell-off. Value and price can definitely part ways. Patience is key.
Right. So he's got this disciplined approach. The market's going wild. How did his partnerships actually do in 1958? Did sticking to undervalued stuff pay off? He'd actually said before he expected to do better in a down market.
Yeah.
And in a rising market, he'd be happy just to keep pace with the averages. And wow, did the averages rise? The Dow Jones Industrial Average went from 435 up to 583. You add in dividends, maybe 20 points or so. You're looking at a total gain for the Dow unit of, 38.5%? That's a serious bull run.
A huge run. And against that, Buffett's partnerships, they averaged slightly better than that 38.5%. The individual gains were somewhere between 36.7% and 46.2%. But here's what's really telling. His take on those numbers. He called them reasonably good results. Why only reasonably good? Because, he explains, a substantial portion of assets has been and still is invested in securities, which benefit very little from a fast-rising market. So he wasn't chasing the hot stuff. He was focused elsewhere, building that foundation.
And he keeps hammering that forecast home, doesn't he? He repeats it again. Our results will be above average in a declining or level market, but it will be all we can do to keep pace with a rising market.
What does that constant repetition tell you about his strategy and maybe how he managed his partner's expectations?
Oh, it's brilliant expectation management. It's total transparency. He's basically saying, look, we're not playing that game. We're not trying to win this sprint in a bull market. Our strategy is built for the long haul, for resilience, even if it means we miss some of those crazy speculative gains. It's risk management. It's about sustainable wealth, not just chasing the highs. He knew exactly what he was doing, and he made sure his partners did too. Okay, so those are the big principles. But how did it work on the ground? With specific investments, he gives us this fantastic example, a really deep dive into one of his biggest holdings then. He calls it a typical situation. Commonwealth Trust Co. of Union City, New Jersey. This is where you really see the thinking in action. He lays out why it was attractive. First, intrinsic value, $125 a share, calculated conservatively, but the market price, only around $50 a share. $50. And the reason for the discount, it didn't pay a cash dividend, even though it was earning about $10 a share. So, like he put it, here we had a very well-managed bank with substantial earnings power selling at a large discount from intrinsic value. Plus, management was friendly, seemed like minimal risk of actually losing money. Sounds almost perfect, doesn't it?
It really does sound good. But, the magic in value investing often is in that combination of factors. It wasn't just cheap. First, it had very strong defensive characteristics. It was safe. Second, good solid value building up at a satisfactory pace. The business itself was growing. And third, this is crucial, there was evidence to the effect that eventually this value would be unlocked. Maybe it would take a year, maybe 10 years, he thought, potentially reaching $250 a share. So it wasn't just a cheap stock. It was a cheap stock with a potential catalyst, a path to realizing that value, and maybe a path he could influence.
Right. And influence it, he did. Over about a year, he and his partners scooped up around 12% of the bank, average price, about $51 a share. And he says it clearly, it was definitely to our advantage to have the stock remain dormant in price. Let it stay quiet so they could buy more without pushing the price up. Smart accumulation.
And as they bought, their influence just grew and grew. By the end, they were the second largest stockholder, had enough voting power to warrant consultation on any merger proposal. This really shows how active ownership can be part of the strategy. It's not just passive investing, sitting back and waiting. It's about gaining a position where you can maybe nudge things along, help unlock that value faster. He wasn't just a stock picker. He was becoming a strategic owner.
He also points out how inactive the stock was. Only about 300 stockholders total. Average maybe 2 trades a month, which explains why the general market buzz had very little effect on the price movement of holdings like this one. But they did hit a snag. Some competition on buying showed up, pushed the price up towards $65. He makes a note about how even very small buying orders can dramatically move inactive stocks, which is why, he says, it's so important not having any leakage regarding our portfolio holdings. Keep things quiet. Secrecy was key.
Definitely. And then comes the interesting part. Late in the year, they sell the whole block for $80 a share. Even though the quoted market price was apparently about 20% lower, they found a specific buyer for their large position. But it begs the question, right? Why sell at $80? If intrinsic value was $125, maybe even $250 eventually, why not hold on? Especially after patiently buying all those shares.
Yeah, why leave money on the table? He actually explains it pretty carefully. He says the timing of when a situation like Commonwealth pays off is to a great extent fortuitous. You can't bank on it happening in any specific year. So looking at just one year's profit has serious limitations for judging long-term results. He goes back to his core belief. Investing in undervalued, well-protected securities offers the surest means of long-term profits. Now, he thought the buyer at $80 could still do okay. Intrinsic value was still way up at $135, he estimated. But the degree of undervaluation at $80 was, quote, quite different from when they bought at $50. The margin of safety had shrunk. And the main reason, his capital could be better employed in the situation which replaced it, opportunity cost.
And that new situation, that's the real key to understanding his capital allocation, isn't it? He says it was bigger than Commonwealth, maybe 25% of their total assets, similar kind of undervaluation. But here's the kicker. In this new one, they became the largest stockholder. And that, he says, offered substantial advantages many times in determining the length of time required to correct the undervaluation. This is huge. He felt he had more control over the catalyst, more certainty about unlocking the value relatively quickly. He was, quote, virtually assured of a performance better than that of the Dow Jones for the period we hold it. It's just a masterclass in rotating capital, always moving money to where it can work hardest, even if it means selling something that still looks okay. Find the best opportunity.
Okay, so let's jump to the end of the letter, early 1959. What's the picture then? How's he adapting as the market continues its run?
Well, he points out the obvious difficulty. The market's higher, so the fewer the undervalued securities. It's just getting harder to find bargains that meet his strict rules. That's always the challenge for a value investor, right? Good opportunities get scarce when prices are high.
Exactly. And he says his preference would be to put more money into workouts, things like mergers or liquidations where the payoff is more defined. But he adds those are also very difficult to find on the right terms, so the easy pickings are gone.
Right. But what I find fascinating is he doesn't just throw up his hands, he gets proactive. Since traditional workouts are hard to find, he says he's attempting to create my own workouts.
Oh, wow.
By acquiring large positions in several undervalued securities, taking control, like in that new situation he mentioned. And this all ties back to his main forecast for his partners, expecting an above-average performance in a bear market. He's adapting his tactics, becoming more active, concentrating positions, but it's all in service of that same core strategy. He's not chasing the market, he's digging deeper.
And he finishes by saying he hopes they'll judge him on that basis, performing well when times get tough. It really says a lot, doesn't it? About how a clear philosophy isn't rigid, it's resilient, it adapts, but it stays true to its core. So, okay, let's try and wrap this up. What are the big takeaways from just this one letter written way back in 1958? It feels like a whole course in investing. Navigating market mania, the slow, careful work of finding value, unlocking it in something like Commonwealth Trust. It really lays out his foundational principles so clearly. It reminds you that great investing isn't necessarily about complicated formulas, but about discipline, clear thinking and discipline.
Absolutely. And I think for you listening, the core lessons are right there. First, have a philosophy, a discipline that doesn't get swayed by the market's mood swings. Second, the power of patience and deep, deep research to find that real intrinsic value, not just guessing stock prices. And third, the strategic edge you can get from active ownership in certain cases, helping unlock the value yourself, thinking like you own the whole business, not just a slip of paper.
Yeah, think like an owner. That's a great way to put it. And maybe here's a final thought, something for you to chew on. If someone like Buffett, even back then in 58, was finding it tough to spot undervalued stocks in an exuberant market and felt he needed to actively create his own workouts by taking large, influential stakes, what does that tell you about the kind of effort, the kind of discipline needed to find genuine value today, no matter what the market's doing? Something to think about as you look at your own investments and the information you're getting.